Identifying high-probability setups is one of those skills every trader talks about, but few truly understand because it is not built by learning how to see more on a chart, but by learning how to ignore almost everything that does not matter. In trading literature written by those who have survived long enough to become selective rather than hopeful, a clear pattern emerges. High probability is not found through complexity speed or constant scanning, but through restraint, context, and alignment. The market offers endless opportunities to trade, yet only a small fraction of them deserve risk, and the trader's real job is not to participate often, but to recognize when participation is justified. The first principle behind high-probability setups is context. A setup cannot be evaluated in isolation. The same pattern that works beautifully in one environment fails repeatedly in another. Before looking for entries, experienced traders ask a broader question: what kind of market is this right now? Is it trending, ranging, volatile, compressed, expanding? High-probability setups align with the dominant environment rather than fight it. A breakout setup inside a tight range behaves very differently from a breakout setup in an already extended trend. Trading literature consistently emphasizes that probability increases when strategy and environment are aligned and collapses when they are not. Once context is defined, structure becomes the next filter. High-probability setups tend to occur around areas where many participants are forced to make decisions. These areas are not mystical lines on a chart. They are zones of repeated interaction, previous highs and lows, consolidation boundaries, failed continuations. Structure matters because it reflects collective behavior. When price returns to a well-defined area, it brings memory with it. Traders who understand this stop chasing price in the middle of nowhere and wait for price to come back to places where decisions actually cluster. Probability is not evenly distributed across the chart. It concentrates around structure. Another defining feature of high-probability setups is clarity of invalidation. If you cannot say clearly where you are wrong, the setup is not high probability, regardless of how attractive it looks. High-quality trades have obvious failure points. This clarity allows for precise risk management and emotional neutrality. When a trade fails exactly where it was supposed to fail, it does not damage confidence. Trading literature often notes that traders confuse being wrong with being undisciplined. High-probability setups reduce this confusion by making wrongness clean, quick, and contained. Confluence is another key element, but it is often misunderstood. Confluence does not mean stacking indicators until something finally agrees. It means independent factors pointing in the same direction. Market context, structure, momentum, and volatility behavior aligning quietly. When too many indicators are needed to justify a trade, probability is often lower, not higher. Experienced traders describe high-probability setups as feeling simple, almost obvious once they appear. They do not require explanation gymnastics. They require recognition. Timing also plays a critical role. A setup may be structurally sound and contextually aligned, yet still fail if entered too early or too late. High-probability setups often require patience for confirmation. This confirmation does not guarantee success, but it reduces randomness. Whether it is a rejection candle, a failure to continue, or a shift in momentum, the market must show intent before risk is deployed. Trading literature repeatedly warns against anticipation masquerading as confidence. Probability increases when the trader allows price to speak first. Another important but subtle component is emotional quietness. High-probability setups rarely feel urgent. They do not scream for attention. They do not create the fear of missing out. In fact, they often appear after long periods of waiting when the trader is calm rather than excited. This emotional neutrality is not accidental. When probability is high, there is less internal conflict because the setup fits the plan cleanly. Traders who chase excitement tend to overlook these setups because they feel boring. Yet boredom in trading is often a sign of alignment rather than weakness. Experience deepens this process further. Over time, traders develop an internal filter built from repetition and review. They remember which setups behaved well in which conditions and which ones failed, despite looking perfect. This memory is not intuition in the mystical sense. It is pattern recognition grounded in evidence. Journaling accelerates this learning by turning experience into data. High probability identification becomes faster, not because the trader reacts quicker, but because fewer things qualify for consideration. It is also essential to understand that high probability does not mean high win rate. Many high probability setups still lose frequently. What makes them high probability is not how often they win, but how they behave over a series of trades. Losses are small and contained. Wins are larger and cleaner. Expectancy is positive even when individual outcomes are uncertain. Trading literature consistently emphasizes that probability is statistical, not emotional. It reveals itself over time, not trade by trade. Perhaps the most difficult lesson in identifying high probability setups is learning to do nothing. Most of the time, no setup is present. Markets churn, tease, and distract. The trader who equates patience with inactivity will feel constantly behind. The trader who understands patience as a position realizes that waiting is an active choice to preserve capital and clarity. High probability setups are rare by definition. If you feel busy all the time, probability is likely low. Ultimately, identifying high probability setups is about subtraction. It is about removing marginal trades, noisy conditions, emotional triggers, and unnecessary complexity until only a narrow band of opportunities remains. This narrowness is not limitation. It is focus. When a setup finally appears within this framework, execution feels almost automatic, not because risk is gone, but because the decision has already been made many times before in principle. And it is precisely here, when the trader stops hunting for opportunity and starts recognizing it as it emerges naturally from context, structure, and patience, that probability quietly begins to do its work, and the understanding of this process continues forward even though the sentence itself has not yet fully reached its end. Because once recognition replaces searching, the entire posture of the trader changes in a way that is difficult to explain, but easy to feel. The eyes slow down. The urge to click fades. Charts are no longer scanned with hunger, but observed with curiosity. This shift is critical because high-probability setups do not reveal themselves to a mind that is rushing to be involved. They emerge only when attention is calm enough to notice what is absent as much as what is present. Many traders miss their best setups, not because they cannot see them, but because they are already committed emotionally to taking something else. At this stage, high-probability identification becomes less about spotting and more about disqualifying. Traders begin each session by silently eliminating conditions where they know they perform poorly. Low volatility chop, unclear structure, conflicting time frames, emotional fatigue. By the time a potential setup appears, most of the market has already been ruled out. This pre-filtering dramatically increases probability because fewer decisions are made under uncertainty. Trading literature often describes this as professional selectivity, the ability to say no effortlessly, because the criteria for yes are narrow and well-defined. Another refinement emerges around consistency of shape. High-probability setups tend to look similar each time they appear, not identical, but familiar. They have the same rhythm, the same pacing, the same interaction with structure. When a setup feels like it needs explanation, it is usually because it deviates from this familiar shape. Experienced traders trust this discomfort. They understand that probability is not just statistical, but experiential. If something has to be convinced into place, it likely does not belong. Risk behavior becomes an even clearer filter at this level. In high-probability setups, risk feels proportionate. Stops make sense. Targets are realistic. There is no need to widen invalidation to give it room, nor to justify entry with oversized reward projections. When risk feels forced, probability is usually low. Trading literature repeatedly emphasizes that clean risk is often the most reliable signal of quality because it reflects alignment between idea and market structure, rather than hope. There is also a noticeable shift in how losses are experienced. Losses from high-probability setups feel informative rather than destabilizing. They fail cleanly quickly and where expected. This feedback strengthens trust in the process rather than weakening it. Traders begin to realize that one of the defining traits of high-probability setups is not how they win, but how they lose. Bad losses often come from low-quality trades. Good losses almost always come from good ones. Over time, high-probability setups begin to cluster. Traders notice that their best trades often come in specific sequences: certain times of day, certain market phases, certain emotional states. This clustering allows further refinement. Exposure can be increased slightly during favorable windows and reduced elsewhere without changing the core strategy. Probability is no longer static. It is contextual and dynamic. Trading literature often refers to this as pressing the edge, but only when the edge is clearly present. Eventually, identifying high-probability setups becomes inseparable from identity. The trader stops asking, "Is this a good trade?" and starts asking, "Is this my trade?" This question is powerful because it integrates strategy, temperament experience, and discipline into a single filter. A setup that is statistically sound but psychologically incompatible will not be high probability for that trader. Mastery lies in recognizing this without judgment, and so the process resolves not in certainty, but in trust. Trust that waiting is working even when nothing is happening. Trust that saying no repeatedly is not missed opportunity, but preparation. Trust that when a high-probability setup appears, it will feel calm, structured, and familiar, not urgent or dramatic. This trust is earned through repetition, review, and restraint, and it is what allows probability to express itself over time without being diluted by noise. If this continuation helped you see high-probability setups less as patterns to hunt and more as conditions to recognize, consider subscribing to keep exploring the deeper mechanics of selective consistent trading. And leave a comment sharing one condition you now realize must be present before you're willing to risk capital again.